All right, Steve, hang with us as we continue our conversation with Stephanie Roth, chief economist at Wolfe Research. Stephanie, welcome. Good to have you with us.
Good to be here.
What did you just hear, and were you at all surprised by what appears to be a little bit of a split on among the voting members of the Fed board between 25 basis points or 50?
No, I don't think it's too surprising to hear that there was a big debate in the room. I think that was largely expected. Powell went in there. He probably wanted the 50. That kind of fits with the articles that were leaked, ahead of the meeting, that it was probably coming from the top that they were looking for a larger cut, and they got a number of people on board. So, of course, a substantial majority was in favor of it, but it probably wasn't Bowman that was the only one that only wanted 25.
Where does this leave us now as we look ahead to November? We had one more jobs report. The most recent one was fairly strong. A lot of people think it's taken another half-point cut out of the probability for the remainder of the year. Is that what you feel?
Yeah, I think 50 basis points is off the table. So now the question is, are they going to go 25 or like Steve was highlighting, there's a 20% chance, at least as according to the market, that perhaps they don't cut at all. Base case for us is that they're able to cut. Tomorrow's CPI should be supportive of that, something with core CPI coming in 0.3, which would be consistent with the core PCE of about 0.23%.
I guess that leaves us, the problem is the next jobs report is going to be distorted, not just by the hurricane, whatever happens. We have Helene, obviously whatever's going to happen with Milton, by the strikes as well. I mean, Diane Swonk was saying we could see a minus 40K drag on, for instance, manufacturing payrolls. How are we supposed to figure out the trend with all of these cross currents?
So it's tough, but the BLS does publish a series within it that excludes the striking members. And then a week before the payrolls print comes out, they publish the strike report. So we should have a good sense of how we can adjust that data for the striking members. There are some people that might be on furlough. That could be about a 4,000 hit. So, but generally speaking, we should be able to subtract those workers. But to your point, on the hurricanes, that's a really difficult one to assess.
Why is the 10-year doing what it's doing?
Because it
wants to. Why?
Well, because the market is now went the other way. Earlier, before the payrolls print came out, the expectation was we're heading into this hard landing. I don't think that was the right view. Then after the print comes out, now it's no landing. I don't think that's the right view either. It's probably somewhere in between. And the 10-year probably will keep
that means soft, right? If it's not hard and it's not no, it means kind of soft.
Exactly.
Right?
I think that's exactly the message. And yeah, the 10-year might be backing up for a little while until the market can come to sort of the conclusion that maybe soft is more likely. But in the near term, probably nothing's going to stand in its way.
So the 10-year is kind of signaling that the economy is in pretty good shape. It's certainly not signaling that it needs that interest rates need to go down to stimulate the economy. Right?
No, and we don't really need much to stimulate the economy at all because the economy is doing just fine. We have almost real consumer spending running at about 3%. The 3-month trend in jobs is 186,000. The economy's fine, but rates are still elevated, and it makes sense for the Fed to be still normalizing interest rates.